Good morning, everyone. As you know, Ryan is not going to be with us for a few days, so we're going to be Pelosi starting World War III. No, I doubt it. Good morning. We're going to be replacing him for the few days he's going to be away. I'm going to be here with you today so we can go through a few stuff. Obviously, I'm not going to be doing exactly what Ryan was doing, but I'm going to be giving you a brief outlook of what has been going on in the markets overnight and early morning. Stelios is going to be with us most of the days as well, at least for this week, right? Let me start by saying that overnight and here in the morning, we haven't had anything significant with the exception of the RBA interest rate decision, right? So other than that, which I'm going to go over the Aussie and the Aussie pairs, other than that, we haven't had anything really significant. We've had some data from the UK, nothing groundbreaking or nothing really important in any case. We've had some Swissy data that more or less came as expected. We had Spanish unemployment change, but obviously that's not going to be a mover of the euro on its own. So on and so forth. Yesterday we had some PMIs, although in general, big PMI data for both sides of the Atlantic is tomorrow, right? Tomorrow we have PMIs from practically, everywhere across the Atlantic, right? And the US data, of course, is later on the day. European data is earlier on the day. We also have CPI data tomorrow morning before this webinar from Switzerland. I'm curious to see how that's evolving, because we have had a quite important move that has been unfolding for quite some time in the Swiss franc. I'm paying close attention to Swiss data and what the SNB, the Swiss National Bank, is doing and will be doing for the time being. I've talked about this extensively on our subscribers webinar on the Morning Edge. Specifically, we had a conversation about the Swiss franc. I would guess it was several days ago, not too many, but several days ago. And I went over the Swiss pairs. Now, let's talk a little bit about the Aussie, right? The RBA hiked by 50 basis points. So now the official rate is at 185, if I'm not mistaken. Let me confirm. Yes, I'm right. It's at 185. They hiked from 135 to 185. So they're moving as well. The Aussie was underwhelmed. The market was probably expecting, something more in the rhetoric or whatever. And so far, the Aussie is actually lower in the day. Specifically, if you notice, we found a high yesterday by testing exactly the 61.8 at 70.50, right? 0.7050. So let's see how we close the day. That will be an interesting rejection if that's indeed what happens post RBA decision, getting rejected from the 61.8. This might be, although this might prove to be a temporary pullback, because I pay close attention to this descending channel that has been working for quite some time. In general, if you want, a very brief technical outlook, in my opinion, this move higher had impulsive characteristics, right? So the move that unfolded from the post-COVID sell-off in risk assets, which also took with it the Australian dollar to these very, very low levels. It bottomed out at roughly 55 cents. right? We had quite an impulsive move to the upside from 55 cents, and we've spent now a significant period of time. It's getting closer to 1.5 years, actually. It's a little bit less than that, but anyhow, we're on our way to 1.5 years of this pullback, which clearly has corrective characteristics. So, if you want my medium to longer term outlook, in my opinion, the next big leg in the Australian dollar is to the upside, right? But we don't have evidence yet that we're bottoming out after 1.5 years of a corrective move lower. We just know that we once again found support at this channel trend line support. We've rebounded higher, and every time we get closer to that channel trend line support, obviously the risk reward favors longs, right? There's no question about that. Now, as a first support for this pullback, I would be looking for levels roughly at 68.70, right? So we might see a pullback towards that level and find support. In any case, as a very short-term development, I will definitely be looking about how we close the day today, because very frequently you see short-term, sometimes even medium and long-term tops and bottoms develop after or during or around an important event, like a central bank decision, right? So keep that in mind. Now, if we want to look at the Aussie's counterpart, which of course is the Kiwi, you'll see that price action is, somewhat similar, a little bit less bearish. I'm paying attention to this area as well because I had some, I had this channel drawn before. So far, we seem to be finding resistance there. We stopped shy of the 61.8, which is exactly the level that we tested in the Aussie. We still have the RSI divergences, of course. So in this case as well, we broke out of this descending wedge. So in this case as well, although the evidence is still quite scarce that we have found the bottom, there is a chance that a little pullback might do the trick and we might continue higher from there. So there are some similarities. Okay, since it's relevant to what we're talking about, Adam is asking if the Euro Aussie is in the zone for shorts. Listen, having to do with the Euro Aussie, first of all, I remain quite bearish the Euro Aussie. If we're talking about medium to long term, yes, we have had a significant rebound from the 78.6 you can see here, quite a big update today, mostly because, practically exclusively because of the move we've seen in the Australian dollar, right? It's a combination, of course, of risk off as well, because we know how well these commodity currencies are correlated with risk on and risk off. We've seen, with all the Pelosi rumors, etc., we've seen some risk off coming through the markets, and because of the sensitivity of pairs like the Aussie to risk on, risk off, is why we also have these crosses like the Euro Aussie, the Euro Kiwi, the Pound Aussie, the Pound Kiwi. We've seen these crosses be very nicely invertly correlated to risk assets, right? So obviously, if we go in a period of risk off again, we should see the Euros, the Euro Kiwi, etc. recover. Alternatively, if this is just a short-term pullback in risk assets, we should see them continue to the downside. Now, on your question, if we are in the area of shorts, yes, we are back testing a congestion of several candlesticks we had over there. So this is a first area of resistance for sure. Now, does this mean that we're going to get rejected immediately from here? As I said before, it has to do mostly with how risk assets are going to respond from here. So yes, this is a first area of resistance. We might, intraday, we've had a very decent move for an FX pair. We've almost climbed by 1.5%, right? So at least a pullback from here might be in the cards. Now, I would be very hesitant to be short, so fast immediately. I tend to believe that even corrective rebounds usually unfold in a more progressive manner, what Elioticians would call like at least an ABC, right? So if you want my opinion, I think that something like that is a much more likely scenario about how this pullback might unfold, right? This rebound, might unfold. So we might pull a little bit back from here, then get another leg towards 150, and then continue to the downside, right? If we want to have a look also at the Euro Kiwi, you'll see that the situation with the Euro Kiwi, as I've explained before, is much more complex than the one in Euro Aussie, because we've in essence been consolidating in an expanding triangle, or otherwise called a megaphone formation, right? We found support by almost testing twice the 61.8, and we're consolidating in the middle of this expanding triangle. And that's why between the two of them, I think, and I've been saying that the Euro Aussie looks much more clear from a technical perspective for quite some time. Okay. Now, going back to the general outlook in the markets, one development that we definitely had yesterday is that the cable did close above the descending channel trend line resistance, so that actually constitutes a bullish breakout in the case of the cable. Now, today we've been consolidating these gains, but as long as we don't immediately slip back within the channel, you should respect this and look for more upside, right? Only if we fail to push further and we just slip back into the channel, we can start talking about that being a false breakout. Until something like that happens, yesterday's daily close was, for all intents and purposes, was a bullish breakout. Of course, the euro is still rather far away from posting something equivalent, right? Yes, it has recovered, but if you notice the descending channel here, we're still some distance away from trend line resistance and a potential bullish breakout. We would need to see a move about 1.038, right? So, there is still definitely some distance to cover before that happens. A result of the result of the cable in generally being much better bid than the euro lately has been this move lower in euro pound, which for the time being is finding support in this descending channel trend line support. But the fact that we've spent 4 days consolidating at the lows without any significant rebound is, in my opinion, sending more bearish signals here, right? So yes, we've been finding support here, but the inability of the pair to actually rebound and just spending days consolidating near the lows makes me think that there is a much higher probability of resumption to the downside than anything else. So keep that in mind. I'm rather pessimistic that the euro pound can recover much from here, at least not from what I see at the moment. Now, one important thing to talk about today is this, right? USD yen. We've been talking about the USD yen. We've been discussing about the potential of USD yen in breaking down and finally producing a worthwhile corrective move since we were developing this ascending wedge, right? We did break below it on a date with important data, and we've now actually, since the daily close yesterday, we also completed the ascending wedges target, right? An ascending wedge or a descending wedge have a natural target of a full retracement. I had explained, and I wrote in my analysis as well, that I was expecting, and I was saying that even when we were testing the first area of support at 134.50, that I was expecting the 131.50 area to eventually be hit. And it has now been accomplished, right? So the ascending wedge has completed, but USD yen still looks very heavy. So keep this in mind. If we actually see a continuation lower from 131.50, in my opinion, then there is a decently more downside coming, right? I actually don't see any proper support until we get down to 126. And 126 is quite a big distance from where we are at the moment, right? So keep in mind, I'm waiting to see how we're going to close the day. So far today, we've been very heavy. Of course, all this weakness that has been coming through the USD yen has clearly been depicted in all the yen pairs, right? Here's the euro yen, which has broken down from this triangle, currently testing a confluence of supports at 134, roughly 134, right? We have a 61.8 there. We have an 88.6. We have the 200 daily moving average. But it's very likely that we're actually going to break through that as well, with 132.50 being the next downside target. If we have a look at the pound yen, there we go. Here's the pound yen. Somebody can say that it actually crafted a double top. In this case, I'm going to say that it's not a double top unless we break through the previous low, right? So this is going to be a double top once we break through, if we break through 155.60. Despite that, we have broken through this triangle, we have broken through the 61.8, and now the next downside target is the confluence of the 200 daily moving average and the 78.6 of the previous move to the upside at 158.36, right? Now, having to do with a double top, if and only if we break through 155.60, then we do trigger a double top that has quite an aggressive downside target, right? Pointing to 142.50. And at the same time, we will have also broken through this long-term ascending channel trend line support, also a very bearish development. Keep in mind that we have been in this ascending channel since March of 2020. What happened then? It is actually when risk assets bottomed after the COVID sell-off. So we have been in an uptrend since then. It's more than 2 years, right? It's getting closer to 2.5 years. We break through that channel and that level. And yes, I'm on board with bearish targets in the medium term, right? For the time being, developments are only, shorter term. Technical developments can only be viewed that, shorter term, because we haven't been breaking big levels. Now, obviously, the yen pair that has been under most pressure today has been the Aussie yen, right? Because the yen has been strong, and at the same time, the Aussie has been weak. So we've already had a 2% down day in Aussie yen. We've had some kind of somebody can even call this some kind of a rounded bottom being crafted here, right? Somebody can even, I guess, see here some kind of an ugly looking head and shoulders formation, although in my opinion, symmetry is very bad. So personally, I don't want to look at it as such. But in any case, the next downside target is the 38.2 of this whole move higher, which comes at 89. 63. And clearly, we should see rebounds towards, I guess, 92 being sold, right? So I do think that, in the short term, this is an impulsive move, and rebounds in Aussie yen should find sellers, right? Now, let me conclude the majors against the yen. Here's the Kiwi yen, multiple tests of this horizontal support resistance area. You can see it there closer to 87, right? Multiple rejections. And we've now broken through 83, 83.10. And this actually does trigger. We have a rough rectangle here. All right. There it is. And this has triggered this rectangle, which has a downside target of 79.80. Similarly to the Aussie yen, rebounds to backtest the 83.10 area will probably find sellers for another leg lower. Okay. So I wanted us to go through the main yen pairs. Yes, of course, we can have a look at more of them. For example, we can have a look at the Canadian yen. Here it is. Notice we've had this ascending wedge here, a breakdown from it. We're now testing this previous low at 101.65. We break through that. The next downside target that we open is at 98.25. Right, quite a significant move lower again. And if you want to look at this as a wedge, also a full retracement of this wedge, right, which is a normal target. So it seems like there is more downside in the vast majority of the yen pairs. For me, as I said at the very beginning, key level here is this 131.50. If we actually close the day below it, then there is more weakness coming in USD yen, which is very likely, and then more weakness coming in the yen pairs as well. Interesting, Lucas is asking about USD Swiss, and he says there is an interesting formation there. Let's have a look at it. And there we go. What is interesting here is that we have this range and we're trying to break below it, right? Double top, with the top being there, the bottom roughly being here. We are testing this area. It was also the 61.8. If we trigger that, then we're looking definitely from more downside. That would be held both by Swiss franc strength or USD weakness, or a combination of the two. Just a reminder, Euro Swiss, which shows how strong the Swiss is, Euro Swiss has been in a big downtrend for quite some time and is actually getting very, very close to its post-crash lows from 2015, when the S&P, without prior notice, released the peg, the floor actually, because it wasn't a peg, it was practically a peg because of the Swiss franc strength. The Euro Swiss was almost pegged at 120 because it actually wanted to go lower, but they had created a floor at 120. So they released that 120 floor, and we had the post S&P crash, right? It then recovered very fast because the S&P on one hand released the floor, but on the other hand, they said that they will keep intervening, and they kept intervening in the FX market to support the Euro Swiss. They just didn't want to have a specific level because they learned by prior mistakes having been made from other central banks as well. See the Bank of England, for example, several decades ago, right? They learned from the mistake they did themselves as well, which is you never should give a specific target for the market to break, right? A floor, a ceiling, a peg, right? Because market forces will eventually make you to have to spend too much money, more than you can afford or more than it's worth, defending these levels, and at some point they either break, or as the S&P, at least they didn't do that mistake. They didn't let the market break their level. They just themselves abandoned that mistaken, in my opinion, policy. And we had that crash. So now they have, as I was saying a couple of weeks ago, for those of you that are members of the ForexAnalytix team, and you have access to our private webinars, we have had this conversation. We have had actually this conversation on F.A.C.E as well. I think I had this conversation with Blake, if I'm not mistaken. I think that the S&P has embraced Swiss franc strength, right? Because despite Swiss franc being strong, they've been showing more willingness, and despite having less inflation, a lot less inflation than the Eurozone, they've shown more willingness to do the correct thing, which is be more responsible, having to do with monetary policy, raise rates, etc. So in my opinion, that shows that they've embraced, or at least they've accepted, Swiss franc strength. And that is what, in my opinion, will keep Swiss franc being rather strong. So the combination of the two, by the way, this level I was talking about is roughly at 96 cents, right? 96 and change, 96.30. So keep in mind that this is a key level in the Euro Swiss. Now, having to do with the USD Swiss, yes, if we continue to see Swiss franc strength, and especially if this high we've seen so far in the dollar proves to be something more than a very, very temporary high, then you should expect the USD Swiss to move significantly lower. And as I said before, I think we're in the precipice of a development like this. Now, if you want something longer term, the next downside target I would be looking for is this ascending trend line support, right? Currently passing roughly from 93 cents. So first target would be roughly at 93 cents. If we continue lower from here, and below 93 cents, in my opinion, there is a lot more downside to come, right? But one level at a time. And for the time being, of course, the opposite, meaning this previous key support at 95.25 should be resistance. So as long as we trade below 95.25, I think there is a very good argument to be made that being short is the place to be. That crash point is what I'm afraid if we break down on USD Swiss. Thanks, Steve. My pleasure, Lucas. Hey, Steve, if you may have a look at the gold silver ratio. Absolutely. We will have a conversation about it as well. In any case, I would actually now move to crude oil and precious metals, right? So let me first go through crude oil because it's very fast. I'm going to reiterate once again what I've said multiple times before, meaning roughly 95.50 is a key support for crude. In my opinion, it will likely not hold for much longer. And I do expect that it's extremely likely that we're going to resume lower towards 85, right? So we're currently testing that support area more or less once again. Yes, I know we're currently trading a little bit below it, but it's early on the day. And for me, daily closes are more important. Yesterday, despite having a very big down day, we pulled back as much as was needed to hold the 200 daily moving average and that horizontal support resistance area. We're now trading below it once again, but let's see how we close the day. In any case, as I've said before, I do think that the chances of breaking through it sooner rather than later are significant, and I do think we can see an extension towards 85 to begin with. Now, silver holding up quite nicely, right? Yesterday, after 3 days of a very big move to the upside, because we got in 3 trading days, we got in silver more than 10%, close to 11% of an upside, right? Despite that, we managed to hold at the highs yesterday. We were negative at some point on the day, and now we have another little doji today. Bottom line, there is obviously strength in this market, and I do expect this to rally even further, even if this is not the low of this cycle that we've seen a couple of weeks ago, right? Even if this is a corrective rebound and we're still within the larger correction lower, I still believe that we're not done rallying higher. And same deal here with gold. I'm looking at this descending channels, trend line resistance passes roughly from 1805. I think we should at least see that level being tested. Now, having to do with the gold silver ratio, which is very, very, very important. I've been monitoring, first of all, we talked about it several times in the past. I think that this might prove to be likely not even a generational high when we needed 130 almost ounces of silver to buy 1 ounce of gold. I think this might be, a historical high, right? I don't think the gold silver ratio is going there again in my lifetime, at least. That's what I think, right? I've been monitoring this appreciation in the gold silver ratio within this channel, which clearly, in comparison to this move lower, has corrective characteristics, right? You'll notice that we've also had significant RSI divergence playing out here. There it is. And despite this overthrow that we've had over this channel, we've now had a sharp move lower and we're back within the channel. Now, medium to long-term outlook, I expect this to break down, right? So I expect a big move coming in the gold-silver ratio. Now, this comment is not a short-term comment, right? Because we're still far away from anything like this taking place. I do think, though, that even if you look at it shorter term, and even if we go on a 4-hour chart, which we might as well do, so here is a 4-hour chart. I think this was a rather impulsive move. You can even see this as a double top, right? That would be the target, which we haven't completed yet. And this looks like some kind of a bearish consolidation, and in my opinion, will bring more downside, right? Notice how oversold we got. This is not a reason to fade something. This is a testament that something actually has strong momentum, right? So I do expect that this gold-silver ratio move, even if it proves to be short-term and not the beginning of something longer-term, which is not unlikely, it has more legs to go, at least one more, right? And that also confirms what I said before, that in my opinion, this rebound in gold and silver, even if it's not anything more than a short-term rebound, is not over, because we know that as a general rule, when both metals are doing well, silver does better, right? So the gold-silver ratio tends to move to the downside when precious metals, monetary metals, are well bid, right? So gold-silver ratio points in the same direction. that gold and silver have more upside, and potentially they have a lot more upside, right? Because if what we saw, and I'm going to wrap it up with that, because what we saw from the Fed was the very, very, very first step, the very beginning of a pivot having to do with monetary policy, then this is the very, very beginning of a big bull market in precious metals. So keep that in mind. And it's, in my opinion, it's not a matter of if, it's mostly a matter of when, right? Because central banks are not independent. Central banks are completely controlled by politicians. And that's why central banks always target, and they will keep on targeting, what is most important for politicians. So once inflation became the #1 priority, because inflation is indeed very, very toxic, right, having to do with monetary policy, it finally became, although it was already apparent that it was a problem, it finally became a strong target for central banks. But what happens when economies go into a big recession and people's priorities, people's #1 priority stops being the erosion of their purchasing power and becomes not having any purchasing power at all? Meaning, if you lose your job, you have no income to worry about its purchasing power. You just want a job so you can get some income, so then you can have the problem of inflation. Because if you have no income, inflation doesn't affect you, right? You have nothing to spend, hence, what you don't have to spend doesn't lose any value, right? So once we go into a deeper recession, which always gets accompanied by high unemployment, then it's very likely that central banks will abandon targeting inflation, which in my opinion, by the way, is going to be a huge mistake, right? Because you don't fix a mistake by doing another mistake, right? Inflation is a huge problem that actually does affect the overall health of an economy, and it's a problem you should address even if you have to go through the pain, right? And of course, if there were not so many distortions and so many trillions of dollars that have been printed globally from all central banks, and so much recklessness having to do with monetary and fiscal policy, that we wouldn't have all this inflation to worry about, right? And economies would actually be stronger, really stronger, not just apparently strong, because even when we have supposedly a strong economy, it's not a strong economy, right? Because we've built economies that are not based on real fundamentals, right? That you can have no strength in an economy by 75% of the GDP being consumption, because the real strength of economy is producing stuff. Consuming stuff is something that doesn't show strength. It's a human habit. I have met of almost no person in my life that is not willing to consume unlimited quantities of stuff, right? There isn't some kind of a magical thing reserved only for the best of cultures to be able to consume stuff. Everybody can consume stuff. The question is who produces stuff. That's where wealth is, in supply, in production, right? Because once you produce stuff, then you can actually have the income to consume stuff. But when you produce little stuff and you consume too much, and you just close the gap between the two of them by going into debt, that isn't economic strength. That is economic weakness, right? That is borrowing from the future to do something today, and that is economic weakness, right? Anyhow, that's it more or less for today. I hope you enjoyed it, and I'll be again with you, same time tomorrow. Stelios is going to accompany us as well. So see you all on the I hope see you all in the F.A.C.E webinar. Bye bye.